Industrial real estate hasn't suddenly gotten complicated. It has gotten honest, though. Some industrial buildings leased instantly. Others sit there quietly, aging like unrefrigerated milk. Same market, same demand, same interest rates. The difference is not square footage and it's not location. It's not even rent. It's power. If you're a landlord with a power-heavy tenant in tow, a buyer planning to operate your own business, or an investor underwriting future demand, this single factor is now deciding whether your building performs or politely falls out of favor. Power no longer supports profit. Power is defining it. I'm Susan, that commercial realtor. Built for business, backed by data and negotiating with bite. I work in industrial and office real estate across Burlington, Halton, and the West GTA. This video explains why electrical capacity has moved from a background detail to a primary valuation driver, and how landlords, owners, and investors protect returns by understanding that shift before the market forces it. No hype, no drama, just reality. For decades, power sat quietly in the background with the assumption that power would be available. Enough amps to keep the lights on, enough capacity to run basic equipment. That era is over. Industry 4.0 changed how industrial buildings are used. Automation, robotics, AI-driven production, smart warehousing, data-dense operations. These users don't tolerate weak infrastructure. They demand reliability, redundancy, and scalability. Budget 2025 has accelerated this shift by making automation and power upgrades financially attractive. Capital moved quickly, buildings didn't. The market is now separating industrial assets into two categories. Those that can support modern operations and those that can't. That separation shows up directly in value. Functional versus technical power. This is where many owners and buyers get tripped up. Technical power asks, how many amps are installed today? Functional power asks, the question the market actually cares about. How easily can this building adapt when real demand shows up? A building with modest existing service but a clear, achievable upgrade path often outperforms a building with higher current capacity but no flexibility. Functional power considers upgrade feasibility, timeline certainty, grid constraints, reinforcement requirements, and expansion potential. The market rewards certainty. A building that can be upgraded within a known path trades differently than one relying on hope or someday assumptions. This is where profit quietly shifts. Power affects value whether owners model it or not. It shows up in leasing velocity, tenant retention, fixturing and commissioning timelines, capital planning, and exit liquidity. Landlords with answers attract better tenants. Owner users with clarity move faster and avoid delays. Investors with certainty underwrite stronger exits. Buildings with constrained or uncertain power paths face friction. More incentives, more downtime, more capital pulled forward. That friction gets priced sometimes quietly through slower leasing and sometimes loudly through reduced buyer interest. Either way, profit follows capability. The most expensive power mistake is under-upgrading. It's waiting. If you're buying a building to operate your own business, buying one to lease a power-driven tenant, or upgrading an existing asset to attract a tenant, confirming power timelines after an offer or a letter of intent is already behind the curve. At that point, leverage shifts. Timelines tighten, risks get repriced, power constraints rarely announce themselves early. They surface exactly when flexibility matters most. Sophisticated players treat power as a strategy, not maintenance. They evaluate what the building supports today, what it can support tomorrow, how long change takes, and where the grid creates friction. They underwrite power the same way they underwrite clear height, loading, and location. They ask whether capital invested in power expands the tenant and buyer pool or shrinks it. They plan upgrades before demand forces that issue. This is not about chasing the biggest service, it's about protecting relevance. Relevant buildings compound value. Irrelevant ones, well, they face functional depreciation. The bottom line, in 2026, industrial value is no longer just about space, it's about capability. Power determines who can operate, who can expand, who commands premium rents or sale prices, and who exits cleanly. Power defines profit. Everything else follows. If you want the other side of this equation, how long power upgrades actually take and where deals get stuck, watch the Power Upgrade Timelines video next. Subscribe if you want industrial real estate explained without filler or hype. Follow if you care about timelines, risk, and outcomes, not headlines. I'm Susan, that commercial realtor, built for business, backed by data and negotiating with bite. Now that you know, what are you going to do about it?